In 2022, an AI model predicted the market crash 3 weeks before it happened. Back then, most investors laughed it off, until it was too late. Now that same algorithm is flashing red again. 4 key data points suggest that another major market correction could be closer than anyone expects. The question is, are you ready? Before we dive in, a quick disclaimer: this is not financial advice. It's for educational purposes only. Always do your own research before making any investment or trading decision. In this video, we'll cover the 4 AI warning signals currently flashing, 3 defensive stocks and ETFs worth watching, and how you can prepare, not panic. Let's get started. The 4 AI warning signals. So what are they? Signal number 1, market sentiment divergence. AI sentiment trackers scanning millions of investor posts have detected a widening gap. Optimism is rising, while insider confidence is collapsing. In plain English, the public is bullish, but the people running the companies are quietly selling. That exact pattern appeared before the 2022 and 2008 crashes. Signal number 2, bond market liquidity. Drop AI models trained on U.S. Treasury flows show a worrying drop in liquidity, nearly identical to conditions before the 2022 sell-off. When bond liquidity dries up, volatility in the stock market tends to surge soon after. It's like removing oxygen from a fire. Chaos follows. Signal number 3, over-leveraged tech exposure. Machine learning data from hedge fund filing shows record exposure to big tech names like Apple, Nvidia, and Microsoft make up over 40% of fund portfolios. This creates a potential domino effect. If one tech stock misses earnings, automated algorithms can trigger a cascade of sell orders across the entire sector. Signal number 4, volatility regime shift. A neural network that's been trained on 30 years of VIX data has identified what's called a volatility regime shift. It's the same statistical fingerprint that appeared before every major drawdown since 1999. Including the dot-com crash and the 2020 pandemic plunge. The model now assigns a 46% probability of a correction within the next 90 days. So, if AI is flashing warning lights, what does safety look like in 2025? Let's break down 3 assets that data suggests could be defensive shelters during market turbulence. 3 safe stocks to watch. Stock number 1, Johnson & Johnson. AI scoring systems that measure financial stability rank Johnson & Johnson among the top 5 most resilient companies in the S&P 500. Even in downturns, healthcare demand remains steady. And with its diversified product lines from pharmaceuticals to consumer health, J&J's revenue stream stays surprisingly stable when markets shake. Stock number 2, Procter & Gamble. Next, Procter & Gamble, the king of consumer staples. When people stop buying iPhones, they still buy toothpaste, detergent, and shampoo. AI risk models rate PG as having one of the lowest volatility scores of any Fortune 100 company. Add in decades of dividend payouts, and you've got a classic defensive play that shines in chaos. Stock number 3, Vanguard Value ETF. Finally, the Vanguard Value ETF, ticker symbol VTV. This fund provides diversified exposure to undervalued blue chip companies like Berkshire Hathaway, JP Morgan Chase, and Exxon Mobil. For investors who don't want to pick individual names, VTV offers a balanced, low-cost approach that historically weathers corrections better than growth-heavy funds. We've linked the official Vanguard page in the description for those who want to learn more. Quick reminder, none of this is financial advice. I'm not telling you what to buy or sell. These are simply AI-driven insights and probabilities, not guarantees. Always double-check data, verify sources, and do your own research before making any investment move. What AI models suggest next? AI doesn't predict the future perfectly, but it excels at pattern recognition. And right now, those patterns rhyme with 2018 and 2022, periods of high optimism before sharp corrections. What to do? This doesn't mean panic, it means preparation, diversify, lower leverage, and focus on companies with pricing power, low debt, and consistent dividends. AI models favor defensive sectors, utilities, healthcare, and consumer staples over high growth tech in the next cycle. Crashes don't destroy wealth, unprepared investors do. Stay calm, stay informed, and let data guide your decisions, not fear. That's all I have for you today. Thanks for watching. If you found value in AI-driven insights, drop a like and subscribe for daily data-backed investing videos. Remember, this content is for educational purposes only. Always do your own research before investing. Finance is your future.